I'm Kern Alexander. I will be speaking in the afternoon and chairing this session. I want to introduce our two speakers. What I'll do is I'll introduce them both before their presentations. And then after their presentations, we'll proceed into discussion where we take questions and comments. Our first speaker is Dr. Vincenzo Bavoso, who's a lecturer at in commercial law at the School of Law at Manchester University. And our second speaker is Dr. Dieter Pessendorfer, who is a senior lecturer in law at Queen's University in Belfast. And they both are financial market law and regulation specialists and have written extensively in their various areas of financial regulation. So we're very happy that they could be here to present at the seminar. Dr. Bavoso.
Thank you, first of all, Nicholas, for organizing this and for inviting me to give me a chance to give this talk. So I'm going to focus on, within the context of Capital Markets Union, I'm going to focus on the project to revive securitization in the EU. I'm going to give a bit of a background, but I think it's not needed given that we've already discussed it in the earlier sessions. So I'll just briefly over some points on that. I'll point out the state of play of securitization post-crisis, what are the main impediments to reviving the market for securitization, and then I will present briefly the various initiatives that have been undertaken by different policymakers, and then my concerns. And I've divided my concerns in four: definition of securitization, what it should encompass, linkages that it can still provide, it can still create with the shadow banking sector, reliance on credit rating agencies, and then broadly a question of regulation. Now, we've discussed broadly, I think I don't need to add much to the fact that in the EU financial sector there's an over-reliance on bank capital as opposed to capital market-based financial channels. When we say that, often we use as benchmark the US capital markets, which is much more balanced in terms of bank-based financial services and capital market-based financial services. Why do we want to reestablish a bit of balance in the EU? One reason is that after the crisis hit in 2008, we started having much increased cost of borrowing. So the funding sources essentially halted. It has been said that the financial health of European banks was in fact impaired. One thing I would add to that is that, yes, the financial health of European banks was impaired also for another reason, and that is the over-reliance of the big European banks on wholesale funding sources as opposed to more traditional retail funding sources. We all know that banks could grow their balance sheet a lot more with reliance on wholesale short-term funding, which had spillovers effect on the shadow banking system. Some people may argue that is not a bad thing necessarily, but it increased to a great extent systemic risk. I will talk a bit more about that later in the presentation. Obviously, I do agree that developing market-based channels of finance alongside bank-based channels of finance is a sound economic initiative. It makes sense to diversify sources of finance, improve capital allocation, and distribute risks in the private sector in a more efficient way. I do buy less the idea of capital market union for SMEs. And my critique here obviously stems from the fact that, to a large extent, capital market union for securitization is very much centered on extending securitization to SMEs. I think in terms of policy prioritizations, it would make a lot more sense to talk about crowdfunding or other ways to channel finance for SMEs. So my critique on SMEs, on capital market SMEs, stems a lot more from the use of securitization in that sense. Obviously, to boost capital markets, obviously there are a number of strategies of market-based channels that are going to be looked at. I think it's fair to say that securitization stands at the heart of this project, alongside others like covered bonds, crowdfunding, private placement. In particular, what we're looking at is reviving a sustainable, high-quality securitization market. And much of the initiatives that have been conducted so far really look at defining what good securitization or high quality, depending on what you want to call the brand, what this concept should encompass, what this concept of securitization should look like. Generally speaking, the initiatives that I'm going to talk about converged, even though there are nuanced differences, around principles of simplicity, transparency, and standardization. The various initiatives have been undertaken by the Prime Collateralized Securities, which is a private think tank, IOSCO Advisory Committee, at EU level, initially by the Bank of England and the ECB, and then with the Commission framework. Again, the aim is to give a different regulatory treatment, a different prudential approach to this label of good securitization, of high quality securitization, so therefore a different risk sensitiveness and capital treatment. What happened after the crisis? Well, obviously, as we all know, the market for securitization after 2007, 2008 has remained very stagnant. Market players have blamed, of course, regulation, in particular the risk retention requirements and the tight capital regime under Solvency II and liquidity cover ratio. But there is also an element of lack of trust in financial markets that certainly has not been re-established after the crisis. So there is still a lack of confidence in investing in capital markets. What these initiatives that I'm going to present in a moment are trying to do is, first of all, to define what should be the economic goal of securitization. What should be the function of securitization? And I think these four functions which are identified, investment, funding tool, a means to transfer risks, and a way to create collateral, this should be borne in mind to understand what are the risks of departing from these functions that are inherent with some uses of securitization. Now, briefly, for instance, what the Bank of England and the ECB initiative has looked at. Well, they've looked at a number of principles that should define securitization. They've looked at the nature of the underlying assets, and it's quite clear that they've excluded reference to complex formula and derivatives. They've said that one of the principles is the performance history of the underlying assets, which has to be made available to investors. The ultimate of rigors is there has to be no reliance on derivative-like claims. The assets originated have to be homogeneous, and this has to be demonstrated by the originator. Receivables transferred to the SPV should be current in payment, not delinquent, so no delinquent obligations. If receivables are secured over assets, the security must be first order. Now, what we get from this set of principles is that there is a clear exclusion, and I think there is convergence on this beyond the BoE ECB initiative. There is a clear idea of excluding synthetic-style products, excluding grey securitization, so essentially screening this new brand of securitization from complexity. So bringing back to an economic use, really. It's interesting to see that two delegated acts at European level have already enacted this sort of approach with Solvency II and LCR. Obviously, the framework is a bit narrow because they apply to insurance and banks acting as investors, but they offer that type of approach. Three core principles: simplicity, transparency, and standardization. So essentially to create a transaction where the risks are more easily accessible through due diligence by investors. And then there are additional risk features, what is called a modular approach according to the different area of the transaction. The EU framework, I think, is quite interesting because it has further developed the debate into a couple of areas that I think are quite interesting. One point I would like to discuss here is the compliance with eligibility criteria, which brings back the debate to what has been discussed earlier by Im and George about what type of infrastructure do we have behind this initiative? Who is going to be in charge of ensuring compliance, the adherence with eligibility criteria, so essentially with this set of principles? And obviously the EU framework, as far as I understand, is not very clear in that. It provides a number of choices, a number of policy directions, but there isn't one clear direction. Obviously there is going to be a process of labeling, this type of securitization, a process of certification, who is going to be in charge of that certification, a new regulator. We have said that basically it's difficult to further empower ESMA. There are constitutional barriers to that, even though I think it would be the most obvious direction in terms of competence. Is there going to be a self-regulatory style licensing system whereby originators self-certify their compliance, which is what some people advocate, for instance, for the risk retention requirement, where currently the onus is on the investors, but that's a different problem. The second point, so this is still a question mark, and I'll get back to that in my conclusions. And the second interesting point is the harmonization of EU securitization, which of course a more harmonized securitization, a more harmonized definition of the transaction would increase transparency, simplicity, and therefore it would make investor due diligence a lot easier. 3 points are raised here. The legal form of the SPV, which I think is a critical feature of the transaction. SPVs, for instance, can be companies, can be trusts. They are different. There are different legal forms and procedure if securitization is conducted in the continent. So harmonization here would be really helpful. Modalities of transfer of the assets from originator to the SPV. Everyone is agreeing that there should be a true sale here, so no synthetic transfer of risk, but a true sale. But again, there's no clear standardization of how this should be done. Rights and subordination of among note holders. This leads to another point I will present in my criticisms. I think it's interesting to see that in respect to harmonizations, some responses to this consultation process have gone a bit further. And I found that the AMF response, the French regulator, offered some interesting perspectives in supporting, in advancing the idea of having a EU-type SPV. So of formulating a EU type of vehicle, of issuing vehicle, that should be granted a European passport. So this would really bring the harmonization argument forward. It would give more clarity and more certainty to the legal form of the SPV. They've also argued that a pre-established public authority, pan-European authority, should be in charge of verifying compliance, adherence. So this again is a step forward in thinking about harmonization. The IOSCO Basel is another initiative that has been conducted. It's a task force actually, and it has recognized again 3 core areas of principles which are then subdivided into more specific areas: asset risk, structural risk, and fiduciary and services risk. Again, there are nuanced differences, but essentially the essence of what good securitization should be is fairly similar. Now, in the context of this consultation process, I've looked at a number of responses from different stakeholders, mostly market players, other regulators, and I think it's been quite interesting to see that obviously, as it might have been predictable, there are frictions. There are frictions, first of all, in agreeing on what securitization should be, on what the definition should encompass, frictions over the criteria more generally. When we talk about streamlining the transaction and bringing it back to economic and social values, if you want, obviously there is going to be disagreement. Many market players have responded arguing that there are potential benefits in securitizing high-risk assets. Obviously, this goes pretty much against the idea of robustness and simplicity that is advocated in the criteria that I described earlier, that have been proposed by pretty much all of the policymakers. I think my observation here is a bit more critical, because I think here there is a level of duality, if you want, with the European Union proposal, with all of these proposals actually, because in one way they want a simpler and more robust securitization, but then they want to securitize SMEs loans. Now, SMEs loans are intrinsically high-risk assets because of the intrinsic difficulty of processing SMEs information. So where do we stand with that? Do we want to support SME securitization, or do we want a robust, simpler, streamlined securitization? The only way to securitize high-risk assets is to resort to pre-crisis trends such as synthetic exposures, complex tranching. I will talk about tranching in a second. So essentially, I think there is a bit of inconsistency about the idea of simplicity. Another criticism about simplicity is that in the pre-crisis year, some transactions, some structures that were not actually simple performed well. So market players have argued, well, why do we need an outright ban? There has been criticism over the risk retention requirement. Of course, there has been criticism on both ways. Some people have said that it discourages risk transfer in cash flow securitizations. But it's also been said that a 5% flat rate doesn't actually reflect the underlying riskiness of the assets. And if we wanted to achieve a real economic alignment of interest, we should bring it up to 15% at least. And I think one important point of friction is the degree to which we want to standardize not just the information disclosure, which is something pretty much all agree with, but standardize the contractual structure, so the transaction structure of securitization, which is what has really led to complexity, to probably undue complexity in the pre-crisis years. To an extent, there is agreement to this because, as I said, it would increase transparency and facilitate due diligence. But obviously, there are lots of concerns about excess of harmonizations, especially when it falls into areas of laws that are very difficult to harmonize, like tax or insolvency, for instance. Same kind of debate over transparency. How much transparency can we ensure in the process of securitizing assets? Now, I move the discussion to what my concerns are, my personal criticism. The first criticism is about the definition of the transaction. So what high-quality securitization should encompass? What should it include? There is no agreement, as I said earlier, between policymakers and market players about what this brand should include. Some market players in particular have advocated a further distinction between good CDOs, which would achieve some sort of economic purpose, and bad CDOs, so those gambling securities that were just aimed at regulatory arbitrage, essentially. Now, CDOs were so complex in the pre-crisis years that it would have been very difficult to create this distinction, to draw a line between a good CDO and a bad CDO. The problem here is also that if we want to, as I said earlier, the aim, the policy goal, the policy objective of creating an SME securitization would obviously have to go through the process of securitizing through CDOs. The only alternative that I see to that is publicly funded sort of securitization market for SMEs assets. So something like something that probably happened in the US after the 1933 with Fannie Mae and Freddie Mac, when they were still government-sponsored agencies before they were privatized. Another aspect of this definition that I think has not been sufficiently highlighted by the initiatives is the possible interconnectedness between the CDO market, or put it simply, complex securitizations, and shadow banking conduits. Obviously, as I said, you may argue a degree of shadow banking is good because it provides alternative source of funding, but obviously what we have to think about is the greater increase in systemic risk that this can create. One problem is the definition that, as I understand, has not been discussed, has not been touched upon, is whether all these harmonization efforts have said anything at all about tranching, about the process of tranching. Now, tranching is essentially the main distinction between a tranched securitization and a non-tranched one is that with a non-tranched securitization, we have a security that is created out of a pool of assets that are held by the SPV. With a tranched securitization, we create an asset with different risks and liabilities, with different risks and returns. So essentially, we don't have one security, but we have a security with different tranches, with different returns. This practice picked up in the early 2000s, really. So it's a fairly recent innovation. It does facilitate diversifying risks, but it also allows securitizing low quality assets, or high risk assets, if you want. It also increases correlation between different banks' balance sheet, because the practice, as it was carried out before the crisis, was accompanied by the use of credit default swaps. Obviously, that as well, the use of credit default swaps is excluded in the policy initiatives, but yet that's how tranching was conducted before the crisis. So this, of course, leads to greater interconnectedness between banks' balance sheet and greater systemic risk. Tranching involves much longer transaction chains, much more complex transaction chains, which involve more parties. For instance, in a tranched securitization, the role of asset managers is much greater. This increases conflict of interest, for instance, between different tranche holders. And asset managers play a part in that. Because the transaction is more difficult and the risk assessment is more complex, there is more reliance on external credit ratings. So essentially, what I'm saying is that the idea of simple and transparent securitization is not really consistent with the practice of tranching, and this is something that should have been embedded in the different policy initiatives. Recently, the BIS stated quite clearly that even with simple and transparent securitized assets, the risk assessment of tranches remains uncertain. My second concern flows from the first one, and is the possible spillovers into the shadow banking sector that can be elicited by certain types of securitization. What in particular I'm looking at is the interplay with the repo market and money market funds or other players in the repo market. Senior tranches were before the crisis, and still are, highly prized collateral in repo transactions. Now, what happens in these transactions is that the assets, so the collateral, is rehypothecated, so it's reused by banks. This, again, contributes to that process that I mentioned earlier, which is the correlation between different banks' balance sheet. So increasing systemic risk. So when we talk of capital markets union and securitization as a way to diversify risk, this is going in the opposite direction, is increasing risk in systemic institutions. So it's not dispersing risk, it's just the other way around. In effect, this is also enhanced, this process of increasing systemic risk, by another practice that was very consistent in securitization, that is some types of credit enhancement mechanisms, like guarantees from sponsors or originators. This defies one of the aims of securitization, the transfer of risk. Because if a sponsor or an originator, which often coincide in complex transactions, guarantees the riskiness of the pool of assets, then obviously in case of default, the risk is going back to the originator. This defies the transfer of risk, or at least it does defy the transfer of risk in the long term. It doesn't do that in the short term. So in the short term, securitization is still profitable in this sense. It's interesting to see that the new liquidity cover ratio do create buffers which are designed to equip banks with the necessary liquidity in case of a run on the repo, a run on their short-term exposures. But again, this measure has been criticized by market players because obviously it creates restraints. Another area of concern is the reliance on external rating. Well, I've said that essentially if the more complex the transaction, the higher the reliance on external credit ratings. I think it's fair to say that after the crisis, the regulation of credit rating agencies has followed two ways, really. There has been an attempt in increasing transparency and disclosure through the enhanced supervision conducted by ESMA, firstly, and then there has been an attempt to limit regulatory reliance on external ratings, when possible, of course, and this has been replaced by internal models or by standardized disclosure. I think both of these strategies are kind of accepted in the policy designs. Especially I think there is a tendency to limit regulatory reliance and to be replaced by internal models or by standardized disclosure whenever this is possible. So whenever we don't really need external credit ratings. I think there is a great danger with internal risk models, which have been advocated, for instance, by Basel in the recent framework. One is that internal models rely on assumptions of market efficiency and market discipline, so essentially the old third pillar of Basel II. And these assumptions have been largely refuted in the last few years. We risk incurring a situation where large institutions will devise their own models, so we have arbitrary capital relief and therefore accumulation of leverage, again more systemic risk. And then if we look at regulation from a macroprudential perspective, internal models really represent the opposite. They represent microprudential approach to risk taking. My fourth concern is about regulation. Obviously, I've got some concerns with respect to the regulation, the infrastructure around Capital Markets Union, but jumping to what I can say about, this is really related to what we can say about the regulation and the infrastructure of the securitization project. What type of supervision, what type of institutional framework are we going to have around a newly devised securitization? And the question has been posed in the European framework. Who is going to be in charge of monitoring the adherence with the criteria? An SEC type of regulator, which I would agree would be the straightforward conclusion, empowered authorities like ESMA, or self-regulation. And the question is, do entities like ESMA have the sufficient funding and resources to face the task? Probably not yet at the moment. My personal point is that, my personal conclusion is that there are risks in the way this project risks being developed, too much power left to market actors, too much laissez-faire, and in the medium to long term, the risk is to get back to pre-crisis level of euphoria, where securitization was essentially employed for balance sheet arbitrage, for short-term profit, not for the economic aims that we have highlighted among those main four functions. And this is what is reflected very much in my conclusions.